Alright, gang, it's your boy Nature, aka Nature. Alright, so we're back for another video game. Alright, so in our last video, we explained what an exponential moving average was. Alright, so we're going to explain simple moving average versus an exponential moving average. Alright, so that's what our next lesson is. Alright, so gang, let's start. It's your boy Nature, aka Nature. Gang. So simple versus exponential moving averages. By now, you're probably asking yourself which is better, the simple or the exponential moving average. First, let's start with the exponential moving average. Okay, so when we want a moving average that will respond to price action rather quickly, then a short period EMA is the best way to go. These can help you catch trends very early with the EMA more than later, okay, which will result in a higher profit. In fact, the earlier you catch the trend, the longer you can ride it and rake those profits. Okay, the downside of using the exponential moving average is that you might get faked out during the consolidation period. Because the moving average responds so quickly to the price, you might think a trend is forming when it could just be a price spike. This would be a case of the indicator being too fast for your own good. This is why we put the EMA at more of 10 or 14. Okay, because it's so fast. With the simple moving average, the opposite is true. When you want a moving average that is smoother and slower to respond to price action, then a longer period estimate is the best way to go. This would work well when looking at a longer time frames, as it could give you an idea of the overall trend. Although it is slow to respond to price action, it could possibly save you from many fake outs. The downside is that it might delay you too long and you might miss out on a good entry price or a trade altogether. As easy as long to remember the difference between the two is to think of the hare and the tortoise. The SMA would be the tortoise, and the hare would be the EMA. The tortoise is slow like the SMA, so you might miss out on getting in trend early. However, it has a hard shell to protect itself, and similarity using the SMA will help you avoid getting caught out in fake outs. The EMA, on the other hand, is a hare. It's like the hare is quick, like the EMA helps you catch the beginning of the trend, but the run of risking of getting sidetracked by fake outs or naps is possible. Below is a table to help you remember the pros and cons, okay, of an SMA and an EMA. So these are the pros and cons. Okay, so the pros and cons of an SMA. Okay, so pros and cons. The pros of an SMA is displays a smooth chart that eliminates most fake outs. Okay, and the cons is slow moving, okay, which may cause a lag in buying and selling signals. So the pros is displays a smooth chart that eliminates most fake outs, okay, and the cons is it's slow moving, which may cause a lag in buying and selling signals. Okay, so let's look at the pros and cons of the EMA. So the pros of the EMA is quick moving and is good at showing recent price swings. Okay, the cons of the EMA is it's more prone to cause fake outs and give missed signals, okay, or errant signals. So when to use the SMA and the EMA. So which one is better? With moving averages in general, the longer the time period, the slower it is to react to price movement. With all else being equal, the EMA would track price more closely than the SMA. Because the exponential moving average is typically considered more appropriate for short-term trading. That the same attributes that make the EMA more suited for short-term trading limits its effectiveness when it comes to long-term trading. Since the EMA will move with price sooner than the SMA, and also often gets whipsawed, making it less ideal for triggering entries and exits on slower chart time frames like dailies or longer. The SMA, okay, which is a slower lag, tends to smooth price action out over time, making it a good trend indicator, allowing it to remain long when price is above the SMA and short when price is below the SMA. So the SMA and the EMA is really up to you to decide. You don't have to limit yourself to a single type of MA or a single instance of an MA. Many traders plot several different moving averages to give them both sides of the story. They might use a longer period, simple moving average to find out what the overall trend is, and then use a shorter period, exponential moving average to find out time to enter a trade. There are numbers of trading strategies that are built around using a moving average that you will learn in the following lessons. The following lessons, we will teach you how to use moving averages to determine the trend, how to use multiple moving averages together, and how to moving averages be used as at a dynamic and support and resistance level. So time for recess. Go find a chart and start playing with some moving averages. Try out different types and try experimenting with different periods. In time, you will find out which moving average will work best for you. All right. So again, in our next video, we will discuss how to use moving averages and how to find trends with using moving averages. All right. So again, it's your boy Nature, aka Nature Gang.